welcome to Money, 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 your personal finance date with me, Surabhi Upadhyay. Well, we're at the start of yet another new financial year, and looking at the interest rate cuts, the forecast of above normal monsoons and signs of improvement in macro parameters, 2016-17 has certainly kicked off on a good note. So what will all of these signs imply for your wealth and your investments this year, especially your mutual fund portfolio? Joining me today to address some of those questions is a very special guest. He's the top boss of India's largest mutual fund house by assets under management, going by the month of March. I'm talking about Mr. Nimesh Shah, MD and CEO of ICICI Prudential Asset Management Company. Nimesh, it's a pleasure to have you on the show, and thank you so much for joining in and taking out the time. So when you came on the show last year and you were giving us a view for 2015, you had said that it's going to be a year of consolidation. That's exactly how it panned out for the equity market. What are you thinking about and looking forward to 2016-17? What should we expect?
So your last show I had said that it will do not come into equity markets if you have got a perspective of 1 year. Right, and be in the equity markets if you have got a perspective of minimum 3 years. So I continue with my call what I said 1 year back, and I say that it will take minimum 2 years for equity markets to give you that kind of return. If it happens before, I don't know which year it will happen. So I feel this next 1 year, next 6 months, next 9 months, I feel as the time to invest. Right, 2016 I would term it as a year of investment, and I'll explain why I'm saying this. Markets will give you return, whether it is 2017 or 2018, I'm not sure, but markets will give you return once, and I'll explain you why I'm saying that. Today, if you see, the market is not that cheap or that expensive. It is neither cheap nor expensive. Market is available at a very reasonably good PE ratio or a high PE ratio of around 19, right? So when you look at the trailing PE, now so why should one invest in relatively highly valued market? Why should one invest in? So the answer to that is that right now the ROEs, the return on the return on equity that the corporates make are at all-time low. Right, Indian corporates have never had it so bad that they have invested money, but they are not making returns out of it. Why that is happening? Because they have not been able to utilize the capacities they have already set up.
Sure.
So we are in such a nice scenario that I see it as a positive in that. I see that if you invest in a company today, you know that without investing further money, the company can make more profits. Right, because they have already set up the capacities. India is a country where demand grows on a continuous basis. So whether it is a cement, whether it is an engineering company or whatever, companies after companies, when we try and examine, we see their capacity utilization lows. And I believe in the next 2 years, they will be able to utilize the capacities that they have already set in.
So you think a lot of this optimism is not already in the price? There's still further headroom from where we are, at least for the next couple of months?
So I am talking everything with a 3-year perspective, nothing with a... So I believe 2016 is a year to invest. And in 3 years' time, equity markets, because corporate earnings will grow up in the next 2 to 3 years, I believe that stock markets can go up. And because of that, we can make reasonable return out of stock markets in the next 2 to 3 years. That's what I'm saying.
Okay, I'm going to talk more about an ideal equity mutual fund portfolio in just a bit. But before that, perhaps a little bit about the industry as well and what investors should be prepared for or what they should expect. Is this going to be a year when we see a lot of new fund offerings come through, or is it going to be a year of consolidation? I mean, one is reading reports these days where the regulator seems to be suggesting that you have to now reduce the number of schemes. I think the suggestion is about 8 for debt funds and maybe just 7 schemes for equity.
I would focus on, rather than more products coming up, it is the question of which kind of products do we promote in the market. We as ICICI Prudential, we have decided that we are going to promote more of defensive products in the market. We have been doing it since last 2 years. Last year also when I came on your program, I said ICICI Prudential Balance Advantage Fund, that which mixes equity and debt both. So what we are telling investors that rather than only investing in equity funds, try and have a mix and have dynamic, what we call in the financial jargon as dynamic asset allocation, is nothing but you allocate between equity and debt on a dynamic basis. If the markets go up, then put more of debt and less of equity. If the markets come down, put more of equity and less of debt. So this dynamic asset allocation products like ICICI Prudential Dynamic Fund or ICICI Prudential Balance Advantage Fund, we believe that is the way to go, especially kind of markets that we are sitting in today. It's a very shallow market whereby inflows and outflows are creating valuations in the market. So one needs to be careful, because those inflows into India can tomorrow also become outflows, and then we'll be vulnerable.
Speaking of flows, what about mutual fund flows coming into the market? Because the month of March we saw a lot of selling by domestic institutions. Yet, are you hearing anything in terms of redemption pressures, or was that at all a factor?
See, last 2 years, since May 2014, mutual funds have practically got more than 6,000 crores every month into the market. We have invested more than 6 to 8,000, anywhere between 6 and 10,000 crores in the market. Since December, the flows have slightly reduced. Since December to January, January to February. March was an aberration. Please don't look at March. March numbers were an aberration. So those, overall, I feel the flows which were around 6 to 10,000 crores have come down to 2 to 4,000 crores. So that's what the range I would give. I don't know exactly what will happen, but that's the range that I see happening in the market as we are talking today.
It's interesting you're talking about flows, because if that number is going to come down to around 2,000 crore rupees, that is the kind of buying we'll see from domestic institution, is that putting the market at a bit of a vulnerable spot in the short term? Should that at all be a concern or a spot of bother for the investor?
Since I said we are investing for 3 years, that should not be a concern for the investor.
Okay.
But looking at the volatility that can come into the markets because of foreign inflows and outflows, we always suggested to our investors that in 2016, don't take one call, take 6 calls. Instead of whatever you want to invest for the next 2 years into equity, finish off that investment in 2016. Don't wait for 2017, don't wait for 2018. Whatever you want to invest in equity for the next 3 years, finish in the next 6 months.
And why do you say that? Why is this 6-month window so critical to make all your investments?
Because I believe that the returns in the market will now come after the earnings of corporates will increase, and earnings for corporates will, I think, they will see a much better 2017-18 than what they'll see in 16-17.
Okay.
So 2017-18 and 2018-19 for Indian corporates will be a better time than 16-17. So invest today, so that when the markets react on the good earnings, you are there to capture the upside. Divide your investment into 6 parts, and every month end, or whenever you, whether daily SIP or weekly SIP or monthly SIP, divide it into 6 to 9 parts and invest regularly in the next 6 months.
All right, we'll take a quick break on that note, but we'll continue the same conversation on the other side. How to construct your mutual fund portfolio, how much should be equity funds, how much should be debt funds, and how to really maximize the idea of getting returns over the next 2 to 3 years. Coming up after the break.